The Federal Reserve cut interest rates by 25 basis points last week, and we are wondering, what does that mean for investors for the remainder of the year?
Welcome to the Secrets to Abundant Living podcast. Your guide on this journey is Amy Sylvis, ready to unlock the keys to a life of true abundance. We're diving into everything from financial freedom and optimal health to meaningful relationships, geographic freedom, and everything in between. It's about creating a life rich in experiences, purpose, and joy. Get ready for empowering conversations, expert insights, and real-life stories that inspire you to live abundantly. If you're ready for the secrets to an abundant life, hit that subscribe button now, and let's get started.
Hey everyone, welcome to today's episode of the Secrets to Abundant Living podcast. The Federal Reserve decided to make a move finally for the first time in a year. And we're here to tell you a bit more about it, talk through what it could mean for us. First, for those of you who don't know me, my name is Amy Sylvis. I am the founder and CEO of Sylvis Capital. We provide hands-off investment opportunities in the commercial real estate space for our investors. And it's been a minute since we've all sat down together to talk about this area of abundance, which is financial abundance, right? So as a quick refresher, we believe that abundance is doing what you want, when you want, where you want, with whom you want, for however long you want. And this financial abundance piece really allows us to live life on our terms, especially if that income is more hands off. So we love on these solo episodes with just me, without our amazing guests, to talk a bit more about what's going on in this financial piece. It is no mystery that interest rates impact quite a bit of what investors do. So as you know, I am a commercial real estate investor. Many of you invest alongside of me in our deals. And if you don't, you may own some real estate other than your owner occupied home. You may invest in stocks or other alternative assets like gold and silver or private lending or commodities. So our goal with today's episode is really to talk through what we think this rate cut means and what it can mean moving forward in terms of our investments and the economy. So a couple of things. The first thing is, let's talk about where we are, and then we'll talk about where we think things may go. This interest rate cut of 25 basis points is likely not going to do a whole lot in terms of a dramatic impact on investments, right? A 25 basis point cut doesn't do a whole heck of a lot. But it may mean, and it may represent a signal to folks. So a signal that the Fed is moving from a position of really putting its foot on the brakes, which is what it is doing to the economy, to maybe moving towards a more neutral position. Have you ever thought about having multiple streams of income? Instead of relying on just one stream of income where you're trading your time for money, how would you like to free up more of your time and live a more abundant life? As a listener of the show, you're invited to attend one of our upcoming trainings where I'll give you an inside look into how you can add passive income and get all the other perks of recession-resistant real estate investing without the headaches of being a landlord. I'll also be sharing some hidden mistakes to avoid and the criteria I personally look for when evaluating potential investment opportunities. To reserve your seat for free, go to sylviscapital.com/webinar. Again, that special link to reserve your seat for free is sylviscapital.com/webinar. I look forward to seeing you on the training. And now back to the show. Again, we look at the 10-year Treasury. It actually went up a little bit after the rate cut was announced last week. And that's because that rate cut was pretty much priced in to the market. But that's probably going to normalize. That's probably going to even out. But as I said, probably not a dramatic impact on investments. But what this may signal to the market is that, again, the Fed is easing off on the brakes, and this may give the courage or some impetus for more investors to come into the market. I'll speak specifically about the commercial real estate space, which is where I'm keenly interested in. And, there have been dramatic, we call them spreads in between, or differences between what sellers want to sell for and what buyers are able to buy given the interest rate environment. And this may cause some folks to jump back into the market and may help with price discovery in the commercial real estate space a bit more. So that may mean nothing to you, and that's okay, or it may mean something to you, and that's okay too. But I like to just give a little bit of information there. What we're also grappling with is, of course, the jobs numbers and these dramatic revisions where, in this lady's humble opinion, it looks like the Fed probably should have been cutting back towards the beginning of 2025, that our jobs numbers have been for several years quite inaccurate. And these revisions are quite dramatic well after the fact. And this was actually echoed by a webinar with Dr. Peter Linneman, an economist that specializes in real estate, that we just had speak to our investor club at Sylvis Capital. He mentioned as well this just really odd position we're in. Obviously, we're reliant on data as investors. The Fed is reliant on data, and the jobs numbers are quite unreliable until they're revised. It seems that's been the pattern over the past couple of years. So we're actually in a much tougher job market than we thought before these revisions, which is a shame. And there's a whole bunch of reasons as to why the market data with regards to jobs may not be as accurate. We're not going to go down that rabbit hole here necessarily, but suffice it to say, that information will probably inform the Fed's next decision. So in July, before we got the latest dramatic jobs revision, the Fed was projecting a 50 basis point cut in interest rates for the remainder of 2025. Now, here we are in September of 25. The Fed just cut 25 basis points, and the Fed is now projecting an additional 2 cuts before the end of 2025. The Fed doesn't always follow its own projections, and of course is subject to what the economy is doing and the data that they receive. So looking forward, it does seem as though interest rates are going to go down. How much? Hey, that is really, really yet to be seen. If we all had a crystal clear crystal ball, we could be more assured, but we can really make our best guess in terms of, again, what the Fed is projecting. And, at minimum, a 75 basis point cut from, we total all of 2025, that could be substantial. That is something that is material to investors, whether they're stock investors or gold and silver investors or commodity, but especially real estate, because that, all things equal, will likely impact our borrowing costs. And when our borrowing costs are lower, we can typically pay more for real estate. Again, all things equal. So it's a bit more of a nuanced conversation, but this is just a high level there. But this is really good news for especially the large institutional capital that's been sitting on the sidelines waiting for price discovery to occur. As we mentioned, that's been a bit of a mismatch over the past couple of years. And when that institutional capital comes back into the market, which we're starting to see, that can also be favorable. I hesitate a little bit. You heard some hesitation in my voice because that's not always the case. So I kind of wanted to soften my language and not be absolute, but it can be quite favorable in terms of price discovery. Again, all things equal. There are several different factors. But again, Dr. Peter Linneman, who, I hope you didn't miss the webinar with him, but if you happen to miss the webinar, the real estate economist, he did say he anticipates that as folks chase yield or chase return with interest rates going down, they're going to be more likely to invest in something like real estate to be able to earn a return on their capital. And of course, the more money that pours into something, the higher the asset prices are going to be. So Dr. Linneman does anticipate the cost of assets or the valuation of assets, such as real estate, to go up, which is a really interesting thing to think about because many folks equate cutting rates, meaning easier money, and maybe that leading to inflation. But he made the fascinating distinction that he doesn't think that inflation, consumer and price inflation, will necessarily go up with everyday goods and services, but the asset prices likely would. So I don't know about you, but I don't want to necessarily be buying when prices are increasing. I'd rather be on the selling side. So this naturally makes me excited that I've been investing over the past couple years, buying properties that are below market value, renovating them, pushing up rents, and giving more value to our residents that once more money pours into the market, we'll be able to sell them. So I think that that's, at least on my end, my investors and I are pretty well positioned for when this happens. Now, does that mean that there won't be any opportunities at a reasonable price for investors to get into, I'll say real estate specifically, because that's my area of expertise? No, there's always opportunity to buy well below market, even when asset prices are going up. So there are different strategies for different parts of the real estate cycle. And we make sure to pay attention, understand where we are in that cycle of the market, and apply the ideal strategy. So we're always able to add some value and increase our wealth there. Now, you may be asking a really good question. And if you're not, I'll help you out a little bit. But that is, Amy, what happens to commercial real estate, namely apartments, when jobs are disappearing and folks might be living on a bit of a tighter budget? And that's a great question. It's one of the reasons why we like specifically apartments, because folks always need a place to live. Now, we want to make sure that we provide appropriate value for a apartment complex that folks can afford, right? That's part of our mission. Is we're not ever buying in markets where, we're just going to jack up the rents and there's nowhere you can go and nothing you can do. You just have to pay. That's not our philosophy and our mindset. We like to buy where and offer something that folks want and can afford rather than force it on them. And that's one of the reasons we like this, B minus type apartment complex type. And for those who don't know, that's kind of these, not a super, super old or super distressed asset, but not a brand spanking new, top of the market, high end finishes. We like something really nice in the middle, because that means some of the maybe folks that were able to afford a Class A type apartment, if they can afford less, they will move down to a type B apartment complex. And so there'll be demand there, but we're not necessarily in the super, super rough, ultra struggling D, C minus, C type apartment complex, where those folks, I hate to say it, tend to struggle the most when the economy gets bad. We don't necessarily want to be in that type of apartment complex either. So we found that being in this middle area is a nice fit for ourselves and our investors. When the economy turns down, it makes those type of folks are impacted by the economy, but not as dramatically. And then also some people downgrade from an A to a B to something that they can more afford. And that gives great demand there for our apartment complex as well. So we're always watching the job market. Of course, no asset class is completely resistant to, a dramatic market crash, but we are, well positioned. We've been through COVID. We have business partners who have been through the financial crisis of 2008, and that informs our decision for the asset class and the strategy, and of course, the location for where to buy. So we pick the most economically resilient way to invest our capital. So this was a bit of a different episode today, y'all, but I wanted to just give you a little bit of inside baseball in terms of what we're seeing with the Federal Reserve, how that applies specifically to real estate, how we're looking through things, how that impacts our buying decisions. And of course, we're eager to see what the job market presents and of course, what the Federal Reserve does moving forward. But we think that having hard assets that cash flow in times when rates are going down, inflation may or may not go up. Time will tell if Dr. Peter Linneman was right with regards to consumer inflation and asset inflation. But we think we're in a great place to be well positioned to take advantage of the market, regardless of where it takes us, because we're in that nice sweet spot. Do me a favor, if you found this episode helpful, send it to somebody in your network. Everyone's interested to understand what's happening with the Fed, and most people are pretty interested in real estate. So we really appreciate you sharing the love, helping us share the information, and giving folks education, because education is power, and we're here to support that as much as possible. All right, y'all, have an abundant day. We look forward to seeing you on the next episode, and bye for now.
Thank you for joining us on another episode of the Secrets to Abundant Living podcast. We hope you found inspiration and valuable insights that will empower you on your journey towards abundance. If you enjoyed today's episode, don't forget to subscribe, rate, and leave a review. Your feedback means the world to us, and it helps others discover the secrets to an abundant life too. Stay connected with us on LinkedIn, Amy Sylvis. Keep striving for your goals, nurturing your relationships, and embracing the adventure that is life. Until next time, we wish you an abundantly fulfilling day.
Hey, y'all, just a reminder, nothing in this episode is financial advice. It is simply financial education and me talking about how I think through things and how I operate at Sylvis Capital. So make sure to contact a financial advisor to talk about your particular investment goals, criteria, time horizon, and risk tolerance. Again, we're just here to provide education, and I just share my own perspectives and my own activities as it pertains to investing.